Evening, everybody. Nice to see everyone out there. All right, let's go ahead and get started. All right. We're going to go ahead and kind of get into some breakout rooms, because what I'd like to do as it relates to the Heritage Doll case is we're going to create 3 breakout rooms. One will represent the board of directors. One will represent the design your own doll deal team, and one will represent the make your own doll deal team. Okay. Each room will have 20 minutes to talk amongst yourselves. The deal teams, your job is to pitch the board of directors on your deal. And it is the board of directors' responsibility to listen to both teams. And then the board of directors team will then have the final 5 minutes to talk about which project they're going to pick and why. Okay. So what we're going to do is go ahead and get into the breakout rooms. I'm just renaming everything right now. Okay. And we can get started. One second here. Hold on a second. Having one slight problem. I had all this set up in Zoom, but for whatever reason, it didn't keep the names of the rooms. So I'm trying to get them put back in here real quick. Okay. So when we get into the breakout rooms, you guys will have 20 minutes. All right. Deal teams, put together your pitch. Board of directors, keep talking amongst yourselves about both of the projects. Okay. Once the 20 minutes is up, we'll get back together. Each team needs to nominate one person to go ahead and give the pitch for each of the 2 deal teams, as well as one person to speak regarding the board of directors based upon the decisions that each of our 3 groups have made. Okay, so everyone at the moment has been assigned to a breakout room. So I'm going to go ahead and open all the rooms, and you are on the clock for 20 minutes. All right, welcome back. Okay, so let's start with the match deal team. All right, who's going to be presenting your pitch?
That would be me.
I'm sorry, who said that?
That's Chad.
Chad. Okay.
Sorry, I'm getting an echo.
I'm gonna mute myself.
Okay. Yeah, I think that fixed it. All right, so we went with the Match My Doll project. So one of the things that we noticed through doing research within the Match My Doll case is we found that the doll industry is actually declining. So we saw that from 2008, it captured a 7.3% market share within the gaming industry, and that's projected to decline roughly 7% in 2013 to 6.8%. So with that being said, it's time for Heritage Doll to think of other ways to make money, specifically outside of that doll industry. And we've released a limited clothing line, and it's had great success thus far. However, it's been very small, and we think there's opportunity for this to grow. So with that being said, we're proposing a greater launch of the Match My Doll clothing line to expand into the 4 different seasons as opposed to just 1. So we'd like to build off of that success and launch this new product line. So with that being said, launching the new product line, because of the initial launch in that beta period, if you will, this project is much less risky compared to the design your own doll case. So this is a medium risk project. And with that being said, again, because we've already gone into the delivery of the clothing line, it requires less initial capital. We already have some type of working foundation to build upon, and there's not as much capital that's needed in order to fund this project. And with that being said, we've also seen that there's going to be it's going to generate positive cash flows much earlier as opposed to the design your own doll project. So we should start seeing positive cash flows 2 years in, as opposed to the roughly 5 years of the design your own doll. And given the positive cash flows that will be reaped early on in the project, as well as the reduced initial capital, there's going to be a reduced payback period. So that payback period would be, let's see here, it'd be 7 years, a little over 7 years, as opposed to 9 years of the design your own doll case. In addition to just the reduced risk in the reduced initial capital, it also has a higher internal rate of return. So that's 24% as opposed to the 17.9% of the design your own doll. And with that being said, it also has a higher profitability based upon the initial capital of 2.37 as opposed to 1.32. We did look at the design your own doll case, and yes, it does seem appealing, especially if you are willing to get past the risk. We did find that the design your own doll project, it does deliver much higher cash flows later on in the project. So if you were to continue on with that project, there is opportunity for you to maybe outpace the overall value. And the other thing to note too is Heritage Doll, it's a doll company. So to create a design your own doll, it fits within the company. It's, if you will, like the flagship product. So it does in a way make sense for us to sell dolls. However, given the declining market within the doll industry, we think it's in the company's best bet to start diversifying our portfolio and focusing on other ways in which we can make money. And that's why we had proceeded with the Match My Doll clothing line.
Great, fantastic. All right, Match, great job. Okay, design your doll clothing. All right, design your own doll. Okay, who's going to be presenting?
I can. This is Annalise.
Okay, go right ahead.
So as Chad mentioned, the doll industry is declining. So just to kind of pose a question to you guys, kind of why would you want to go with a project that is relatively similar to what they're already doing, just kind of as an extension versus choosing a project that steps outside of the box? To start, both projects are profitable opportunities with relatively close MPVs, but design your own doll offers a greater benefit, and here are the reasons why. So first, to start off, it is definitely more innovative than Match My Own Doll. And in an already very competitive industry, it makes it harder for its competitors to replicate, thus giving them a competitive advantage. The second point to mention is that Heritage Doll does have the financial capabilities to take on a slightly riskier project that has more upfront costs, but it does offer potentially a longer term benefit. The third point to mention is there's greater potential for future growth. Again, as Chad mentioned, it has greater free cash flow over the lifespan of the project. And actually by the last year, they bring in approximately $584,000 more than Match My Doll. And why is this important? It allows for greater opportunity to invest in future projects, but more importantly than that, they have the ability to pay both their shareholders and debt holders, which will make the company look a lot more attractive for future investors if they're considering entering into the doll industry. And then the last important point that we kind of considered is there's a greater upside potential. So the growth rate was estimated very conservatively at 3% for both projects. Now, realistically, that probably wouldn't be accurate and the case. In fact, it could be argued that Design Your Own Doll would actually have a higher potential growth rate due primarily to its innovation, and that's kind of where the risk comes in. They would be first to the market, and with this new technology, and if it does catch on, then it would be expected to catch traction and not only retain the company's current customers, but it would also attract new customers, growing their network and creating a higher terminal value. And so those are the reasons that we said that Design Your Own Doll was a better opportunity.
Oh, I'm digging it. I'm digging it. Two deal teams trying to sell their product. Okay, board of directors, time to decide. What do we got? Who's going to talk? Looks like somebody may have changed their mind. Who's talking? Board of directors. Bueller.
I thought we were going to break out for another 5 minutes to discuss.
Oh, would you like to break out for another 5 minutes to discuss?
It would probably help if we could just, kind of get our thoughts together after the pitches.
Okay, break out for 5 more minutes. Everybody's go back into your breakout rooms, 5 minutes for the board to decide. For the other
You did? You did.
All right, we're back. We're back.
Oh.
All right. Who's going to be speaking on behalf of the board? The chairman of the board.
I don't know if I'm that important, but I'll talk.
All right, go ahead, Will.
All right, so sort of in our regroup session, we kind of weighed the pros and cons of both pitches, and we think that both teams did a pretty compelling job of arguing why their projects should be selected. But to not leave anyone waiting, we're going to go with the clothing project. Mostly because it seems like the best current project available. The Design Your Own Doll project. We did like that project, but I think our major concern is that it's just too risky right now. If you kind of think about how most of the cash flows are backloaded in that project, and there's sort of a significant time horizon for it, coming into the 10-year mark, like that's a really, really, really long time to anchor that much capital into, one specific project, especially when, trends in the toy industry change, probably every 3 years. I mean, if you think about, what kids were playing with 10 years ago, that was one of the early iPhones. That was like PlayStation 3, maybe. And, since then, technology has increased really, really rapidly. And, we kind of thought that Project 2, while it is a tech platform, it was missing even some sort of current tech standards for toys by today's standards. There was no mobile integration. Most kids have phones now. So there was no connectivity into like a larger ecosystem. Connected toys are a really big trend in the space. So we would have liked to see that in Project 2. And, with technology advancing, we see sort of AR being one of the big sort of advantages in the toy trend in terms of personalization. So while we like the idea of a personalized doll, that project didn't seem forward focused enough to justify, the incredibly long payback period for it. So with that risk in mind, Project 1 seemed like a much safer alternative to us, and still hitting all the positive financial measures, positive NPV, positive IRR. So, we're going to go with Project 1 just to hedge our bets, hoping that, maybe next year, the team that came up with Project 2 can retweak it to be, sort of more aggressive and innovative with, a tech-powered play.
Right. I love it. Okay. So let's kind of go through it. All right. So both deal teams picked up on exactly what this case was trying to convey to each of you. Okay. And I think the decision that the board made is the right decision to make given the current market environment and the industry as a whole for the doll industry. Okay. It's been in decline. It's got relatively slow growth. Okay. The way that the capital budgeting process as communicated within the case basically says that it's based upon how much EBITDA the company makes. So if we can make more EBITDA early on, then we have more money to spend sooner than later. So, the design deal team was 100% right that it's a higher risk, it's got higher reward, but that reward is projected to come much later on in the life cycle of the project. Okay, so the present value of those future cash flows is taking a little bit of a hit. And we generate fewer EBITDA dollars early on. Okay, so we start to say that means we have less capital to spend for future projects. So if we're in a declining industry and in a declining market, but we can put some capital into our business and we can generate additional EBITDA more than Project 2, then that means in theory, for the next couple of years early on after this project goes in, we will start to generate more EBITDA, and therefore as a percentage of EBITDA, we generate more capital monies that we can then spend. Okay, so the key point to part of this case was that we're treating each of these projects as mutually exclusive to one another. We can't do both at the same time. So we needed to pick the one project, okay, that gives us, all right, the biggest bang for our buck, all right? And the clothing project does do that. It delivers more net present value in those first 5 or 6 years than the design case does. Okay. With that said, okay, the design your own doll, right, creates a little more of a connection between that little girl or boy who designs their own doll, and it creates a little bit more of a stickiness factor. Okay, but it would take time for that stickiness to get put in place within the market. All right, so I'm just kind of taking notes as everyone was speaking, and you kind of alluded to that. All right, so we don't really know if the terminal value of the design project, the design your own doll project, we don't really know if that 3% growth rate, okay, just like Annalise was saying, we don't really know if that's 3%. Hell, it could be 5% if it really takes hold and we build that connection with our consumer through the design project. That perpetual growth might not be 3, it could be 5, right? In which case that may sway the decision a little bit. Conversely, if the clothing project, all right, that's just kind of doing the thing that Heritage has always been doing, all right? That's their wheelhouse, right? So maybe on the terminal value for the clothing project, maybe a 3% perpetual growth is overestimating the growth, all right? So if you had done a sensitivity, okay, on that perpetual growth rate, right, and you dropped the perpetual growth rate for the clothing line from 3% to 2%, okay, and left the design project at 3%, all of a sudden you would have seen a change in the net present value to the point where the net present value of the clothing project actually drops down below the net present value of the design project. Okay, so I think you guys have done a great job with this. I've really enjoyed. I haven't finished getting through all of your papers yet, and I didn't want to post grades or anything until I finished everybody's. But I've been really impressed with the quality of work that you guys submitted on these 2 projects. So I have to agree with the board on this one, that in terms of the risk that's facing Heritage Doll at the point in time that this decision has to get made, that going with a project that requires less capital outlay right away generates a higher cumulative 5-year EBITDA versus the design project. So we get more dollars coming in the door for each dollar that we're looking to spend, which means that next year, the amount of capital that we have available to spend within the business is higher than what it would have been had we chosen the design project. Okay, so based upon the current risk, the current state of the doll industry, I got to agree with the board on their decision to go with the clothing line. Okay. Hope you guys had fun with that. All right. It's one of my favorite cases to do. Okay. Moving on. All right. Did anybody have any questions from last week's asynchronous week dealing with stock valuation?
I have more of a comment. The past 2 classes, like since we've started bonds, I am like completely lost on the calculations. I'm going to be completely honest with you. Like I really struggle with the Connect homework. I did not understand the Walt Disney case at all. So I'm pretty sure all of my answers are wrong. So yeah, I would.
All right, well, why don't we review the Walt Disney case? Would that be beneficial for everybody?
Yes.
Yes, please.
Okay, let's do it. All right, and then we can go back and we can have more discussion on bond pricing, and we can talk about stock valuation. We'll kind of combine those for a little bit tonight, because what we're going to get to after that, we're going to take it slow for this week and next week in terms of math and using Excel. Okay, so why don't we make sure that we solidify your understanding of bond valuation and stock valuation before we move into just some lessons from the capital market history. So I'm firing up Excel right now, and assuming I don't have any issues, I will have the Disney case opened here in just a second. And why don't I also, while we're doing this, I'm going to fire up the lecture on bond valuations, and we can go back and take a peek. So Annalise, in terms of the understanding of the bond valuations, is there a particular part of the valuation process that wasn't clicking, or just?
I mean, to be honest, like pretty much all of it, but I just think I'm struggling with pretty much all of the calculations, how you calculate, whether it's from 2 weeks ago from the Walt Disney case, what is it, the bond price,
Right.
and then from the asynchronous class, just all of the calculations that were in that as well.
Okay, so I'm opening the Disney case right now. So we'll review that. Give me just a second. And so I will be honest with you guys too. So years ago, when I was going through the very similar course that you guys are in now, my brain comprehends equities a hell of a lot more than my brain comprehended bonds. Okay, so if you're struggling with bonds, don't feel bad. Okay, because sometimes I feel like it's a right brain, left brain thing, and if you really understand equities, then sometimes we have a hard time understanding bonds, and if you understand bonds, sometimes it's challenging to understand the equities. So let's go here, here, here. And let's open up Excel. And I'm going to bring it over here. I'm going to go back to Moodle real quick so I can see the questions that were asked. And then I'm going to share my screen and we will be good to go. Okay. Okay. I'm going to share my screen now. Okay, so we had the Sleeping Beauty bonds. We were told that they were issuing the entire value of the bond issuance was $300 million. The bonds were going to be issued for a maturity of 100 years, okay, a century bond, right? We were told that the coupon rate of the bond was 7.55%. And we're going to use the par value of 1,000 like the questions indicated. Okay. And, you know, again, to the question that Morgan had asked 2 weeks ago was, why is it $1,000 versus $100? It doesn't really matter what it is. It's just easier to denominate the issuance, the fewer number of bonds that can be purchased if you're using the $1,000. Because as Morgan picked up on, the $1,000 is kind of a circular reference. Okay, so it's just easier for the folks who are doing the bond issuance and the traders who are dealing with the bonds to trade in $1,000 increments. Okay, so the first question was, what are the cash payments that were associated with the Sleeping Beauties? Okay, and if we think about what are the cash payments for a bond, all right, in terms of cash flows, when you buy the bond, okay, you get the coupon dollars, okay, the interest that you earn for owning the bond, right? So in the case of the Sleeping Beauties, okay, the first question was, how much money are you as the bond holder making every compounding period? Okay, so we were told that we got 2 payments per year. So we know that it's semi-annual compounding. So the answer to the first question is the coupon rate of $7.55%, that's our annual rate, times the par value of the bond divided by 2. So on a full year basis, we make $75.50, right? But every compounding period, we receive $37.75. Okay, that's the cash flow, right? That's the cash that we have coming in the door every 6 months from the purchase of the bond. Okay, for the 100 years. Okay, so for 100 years or 200 compounding periods, because we get paid twice a year, every compounding period, we get $37.75. Okay, which leads us into question 2. Question 2 was, what's the detailed cash flow for each compounding period? Well, we know that in period 1, we get the coupon. In period 2, we get the coupon. So 6 months, 6 months. So for the first year, okay, we get the $75.50. Okay, but for every compounding period, we get $37.75. Okay, and if we hold this bond until it matures, right, in 100 years or 200 compounding periods, then we can see that at the very end, in the 200th period, we get the coupon payment and we get the return of our investment, or the $1,000 par value returned to us in that 200th compounding period. So for periods 1 through 199, the only cash flow stream that we have is the coupon payment. Now, I'm going to say that again because I want you to remember what I say about bonds, because when we get to stock valuation, okay, you're going to see something very similar to how we're pricing bonds. Okay, so remember the cash flow streams, okay, your expected return, right, is the yield you receive from the dividends, aka coupons. So the yield that you get from the coupons plus the capital gains yield that you get when you eventually sell the item, the bond or the stock. Okay, so from a cash flow standpoint, compounding periods 1 through 199, the only cash flow stream that you have is the coupon that you receive of $37.75. And in that 200th period, okay, you get the coupon payment, your final payment, and then you also receive the par value back. Okay, so question 2 was just to get you to create the cash flow for each of the 200 compounding periods. Okay, does that make sense? Annalise?
Yes.
Okay, all right. So we've got cash flow. We make this investment of $1,000. We got cash out of $1,000, and in return for that, we get paid an interest rate, a coupon. Okay, each compounding period, that coupon is $37.75, which is calculated based upon the coupon rate of the bond of 7.55% per year on a $1,000 par value. So when the bond was issued, it was issued at $1,000 of par at 7.55% interest per annum, and it compounds, we get paid semi-annually. So you take the 7.55% per year times the par value, that's your total year's worth of coupon you receive. You divide that by 2. So each compounding period, each coupon period within the year, you get paid $37.75. Okay, that was question 2. Okay. Question 3. All right, now this is where we're going to prove where the $1,000 kind of comes from. Right. So when we said, and I did one extra step here just to kind of show the math before we get to the actual question itself. So when we know that the price of the bond, okay, on day 0, okay, on day 0 before the bond begins trading, okay, the $1,000 par value must be the sum of the present value of all of these coupon payments. It's got to be the present value of all these coupon payments from compounding period 1 all the way down to compounding period 200. Okay, so the present value, okay, of all 200 future value coupon payments at 7.55%, okay, at the coupon rate of the bond issuance, okay, the present value of all of those coupon payments is $999.40. Okay, and we get that by simply using, pardon me, the present value formula equals PV. Okay, equals PV. We open the parentheses. First variable is rate. Okay, so we take the full year rate of 7.55 divided by 2 because we have to adjust for the compounding periods. Okay, we have to look at the number of compounding periods that we have with this associated with this bond. Okay, the number of compounding periods is the 100 years times the 2 times per year based on semi-annual compounding. Okay, once we know that, then it goes to the next variable. Well, what's our payment? How much money are we getting, okay, every single compounding period? Well, we're getting $37.75. Okay. There is no future value for the coupon at the very end because it is nothing. It goes to 0. Right? We're not getting anything in the end at the 200th compounding, at the 201st compounding period, or the 200th compounding period. We're not getting anything more than that final $37.75 coupon payment. Okay, so the present value of the coupon payment stream, okay, the sum of all of the period 1 through period 200 future value coupons discounted back to today's dollars at 7.55% says that the present value of all those coupons is $999.40. Okay, so that's part 1.
I have a quick question there. So can you explain the relationship between coupon rate and yield to maturity?
We're going to get there. We're going to get there in just a second.
Okay.
Okay, stick with me. Stick with me. And yes, I will 100% answer that because that's a very important number, right? But on days, and so this is like day 0, all right, before the bond begins trading, right? So the present value of the coupons is $999.40. And then, but we have a final cash flow. We have another cash flow that we have to figure out the present value of. And that cash flow is the $1,000 par value that we get back in that 200th period. Okay, so we have the present value of all the coupons, and then we have the present value of that future par value. Okay, do it the same way. We use the equals PV function, right? Except this time, right, we're using the same rate, 7.55%, because we're still at day 0. So the coupon rate divided by 2, okay? The number of periods is still 100 years times 2 for the number of compounding periods. We don't have anything that we got to deal with in terms of the payment because we've already taken care of the coupon payment in part 1 of the calculation. So there's no payment, so that's just 0, right? And then what's the future value? So the future value is the return of par value in that 200th compounding period, hence the $1,000 future value within the calculation. Okay, and when we do that, right, we see that the present value in today's dollars, okay, what is $1,000 100 years from now worth today? It's worth 60 cents. Okay, so what I want you to focus on here is the farther out the curve time-wise that it takes us to get this money back in terms of the repayment of par value in the case of bonds, or if we're talking about stocks, okay, the farther out that we push the eventual sale of the holding that we might have, the more that present value approaches zero. The impact of that, the return of principal, the farther out the curve you go, the impact on that approaches zero. And therefore, over a long enough period of time, the total value of the bond would be entirely comprised of the present value of the coupons. Okay, so the farther out the curve you go time-wise, okay, the less of an impact that return of principal has, and the more of an impact on the price of the bond that the coupons does. Okay, so the bond price, okay, mathematically is equal to the present value of the coupons plus the present value of the future par value. Okay, and those two things put together give us the bond price of 1,000. Okay, which is the par value of the bond issuance, right, on day zero. Okay, that is kind of the starting point for question 3. So question 3 was, okay, suppose on day 2, okay, day 2 of trading, day 1 of trading, the bond has been issued into the market, it's been completely sold, and now people who own the bonds want to start trading the bonds. Okay, so question 3 says, if the prevailing interest rates in the market moved up by 1% to 8.55%, okay, what is the trading price of the bond at that point? Okay, what should that bond now be trading at within the market? Right? So remember what we talked about. Okay, as interest rates move up in the market, okay, higher than the coupon rate of the bond, that because the coupon rate of the bond doesn't change, right? This bond was issued, okay, at par value of 1,000 for a total of $300 million, okay, on a 100-year maturity at 7.55%. So if you wanted to go out and buy this bond, right, on day 1 of trading, okay, you're not going to get whatever the prevailing interest rates are in the market. You're still going to get 75.50 every year or 37.75 every 6 months, right? You don't get the market interest rate for the bond that you bought. You get the coupon rate of the bond, okay? So the question 3 said, all right, on day 1 of trading, okay, the prevailing interest rates in the market moved from 7.55 to 8.55. Okay, they moved up by 100 basis points. All right, so that 100 basis point increase in the yield to market, okay, the prevailing interest rates within the market, how does that change the present value of all of the cash flows that are now associated with this bond? Okay. So we do the math the same way, except now, all right, the rate that we're going to use is not the rate on the bond issuance. It's the prevailing market interest rate or the new yield to market on the bond based upon whatever, based upon the Fed's change in monetary policy. They've moved interest rates up, therefore market rates in the industry have moved up. So the new market rate is 8.55%. That 8.55 now impacts our discounting. Okay, just like you guys did within the Heritage Doll case by using two different discount rates, you could think of the yield to market as a new discount rate. Okay, so when we look at what's the price of this Sleeping Beauty bond when the prevailing interest rates move up by 100 basis points, we do it the same way. Okay, except now the rate that we're using is the yield to market, right? The yield to market, okay, is now 8.55%. So our rate is 8.55% because we're discounting at a higher rate, okay? So if we're discounting at a higher rate, okay, what should that do to the present value of our coupons? Okay, if we're going to be discounting at a higher rate, should the value of our coupons, the present value of our coupon payments, should we have a higher or a lower number there if we're discounting at a higher rate? You can figure it out if you see the math. Okay. We got to have a lower number because we're discounting at a higher interest rate. Those future dollars, okay, are worth less to us in today's dollars as our coupon rate, as our yield to market, as our discount rate goes higher. Okay. So we have an 8.55% rate now. We still have the same 100 years, okay, or 200 compounding periods. And this is pay attention here. We still have the same coupon. We're still getting the same $37.75. Okay, that doesn't change. You bought the bond with a 7.55% coupon rate. So whatever happens in the market does not change the dollars that you receive for the purchase of this bond. Okay, so you have the same coupon payment. It's just now being discounted at the yield to market, which has moved up because interest rates in the market have moved up. So when we calculate that new present value for all of those same coupon payments at the 100 basis point higher interest rate, okay, we now see that the present value of all of those 200 coupon payments is no longer $999.40, but rather $882.84. Okay. We do this. Go ahead.
Sorry, I have just a quick question. I just want to make sure I'm understanding it. So what I did was pretty similar to that, but I think I'm still just a little bit confused. I did the rate as the market rate, but the payment, which was I put as 8.55%, but I did the payment as 7.55% in the present value formula. So I think I'm just a little bit confused why you wouldn't do that again.
Okay, so
because I got a very similar answer. I think I was like $1 off.
Okay, so the rate that you were using was 8.55.
Correct, but then when you get to the payment part, I used 7.55.
Right, so the payment part is the $37.75. Okay, that's the coupon payment that you're getting.
Okay.
Hold on. See. Oh, I'm on the FV. Sorry. Let me go. I was on the wrong variable here. Okay. So you were using the 8.55 as the rate.
Correct.
Right. We were using the 100 years times 2 for the number of compounding periods. Mm-hmm. Right. And for the payment, the PMT, we're using the 37.75, which if you were using 7.55 times 1,000, then you would have been okay.
Yeah, I got 883.07 as my answer though.
Yeah, that's the total price. 883.07 is the correct answer for question 3.
Oh, okay. I was looking at just the 882.84. Okay.
Right, the 882.84 is part 1 of the equation, right? The 882.84 is the present value of all those coupons at that higher yield to market. And then you got to do step 2, which is the present value of that future return of par value of 1,000. So like it was 60 cents on day 0. Well, on day 1, when rates moved from 7.55 to 8.55, the present value of that future $1,000 is no longer 60 cents because now we're discounting it at a higher rate. Okay, so we still have the higher rate divided by 2. We have the 100 years times 2, and we have the $1,000. So we're still discounting that $1,000 back into today's dollars. We're just doing it at a higher rate, and therefore the present value of that $1,000 100 years from now is now only worth 23 cents. So the sum of the present value of the coupons and the present value of the future value is 883.07.
Gotcha. Okay. I'm with you. Thank you.
Yeah, no problem. Okay. And if you think about it just kind of from an economic standpoint, that the inverse relationship between bond prices and interest rates kind of makes sense. Okay. You own this bond paying 7.55%, and you paid $1,000 for it, or it was worth $1,000 on day 0. And due to changes in monetary policy, interest rates in the market moved up to 8.55%. So that means that new bonds that are getting issued into the market on day 1, okay, are now being issued with coupon rates of 8.55%. Okay, so if you wanted to sell your bond, okay, if you wanted to go out and sell your bond, so directionally speaking, then how do you incentivize a buyer to purchase your bond if new bonds are being issued at 8.55% and also $1,000 par value? You'd have to drop your price, right? You got to lower your price. So it makes sense conceptually why the prices of bonds at lower coupon rates than the yield to market are priced at a discount. Okay, so as the yield to market, okay, exceeds, goes above, is higher than the coupon rate of the bond, okay, bonds will trade at a discount to par value, okay, because you're discounting all those future cash flow streams at a higher rate. Okay, so when the yield to market is higher than the coupon rate, the bond will trade at a discount. Okay, so that was question 3. Right. Question 4 went the other way. All right, let's say that the bonds in the prices in the market, the interest rates within the market dropped by 100 basis points. Right? What would cause that? Right? Why would rates go down in the market in general? Anybody have any guesses, any ideas, any thoughts? Why would the Fed change monetary policy to lower interest rates in the market?
To promote like borrowing from businesses to speed up. Yeah, just what Will said. To
Yeah.
promote lending.
Exactly. Okay. We want to encourage more lending. We want to start pumping the economy. We want to start borrowing so that we can improve the economy. Okay. Maybe we're starting to go into recession. Okay. So rates start to come down in order to prop up the economy. Okay. So question 4 was, let's go the other way. Now, interest rates in the market, prevailing rates, yield to market, okay, has dropped to 6.55%. Same math that we just did, except now we're just discounting at a lower rate than what the coupon rate of the bond is. Okay, So we're using the 6.55% as our yield to market, as the rate, okay, within the present value formula. Same number of compounding periods, same payment, still the same 37.75, okay? But now, because prevailing market rates of 6.55 are lower than the 7.55, okay, of the bond itself, we can see that now, because we're discounting at a lower rate, the value of those future coupon cash flow streams is now 1150.84. They're worth more to me now, okay? And the present value of that future $1,000 is now worth $1.59, okay? And therefore the sum of those two components gives us the total price of the bond of 1152.43. So we have discount and we have premium. Okay. So when the yield to market falls below the coupon rate of the bond, okay, the bond will trade at a premium to par, because you're now discounting those future cash flow streams at a lower rate. Okay. And again, if we think about it conceptually, it makes perfect sense. You own a bond, all right, that's paying 7.55%. The Fed changes their policy. New interest rates in the market are 6.55%. New bonds being issued in the market are now being issued at 6.55% at par value of 1,000. Okay. You own a bond that's going to continue paying 7.55 for 100 years. Okay. People are going to be willing to pay you more money for your bond because you have a bond that pays 100 basis points higher coupon rate than what the prevailing rates are within the market. Okay. So when the yield to market is less than your coupon rate, then the bond will trade at a premium, and that's what we see. Okay. So day 0, day 1 with 100 basis point increase in market rates, day 1 with 100 basis point decrease in market rates. Okay. And the two components adding up to the price of the bond at those 2 points. Crystal? Any questions? I want to make sure you guys understand it. Okay.
Can we have this spreadsheet, please?
Oh, yeah, sure, no problem. Yeah, I'll make a note to put it up there. I meant to do that anyway. Okay. And then the final question was, give me a graph that shows the relationship between price and yield to market across interest rates in the market ranging from 2 to 20% in 1 percentage point increments, right? So 2 to 20, okay? And if you set your Excel up properly, you only had to do this calculation one time and then you can copy and paste it, okay? So we have the price, okay, comprised of our 2 components, the present value of the coupon plus the present value of the future par value at the 2% rate. Okay, so we have the number of periods, we have the par value, we have the coupon payment. So all the variables that we need and the rate, all the variables that we need to go into what's the price of this bond if interest rates in the market are 2%. Okay, and if we use our dollar signs properly, okay, to fix cells and fix columns, okay, or fix rows, fix columns actually, then all we have to do is copy that one formula and paste it all the way down, because the only thing that's changing, okay, in this formula Okay, the only thing that's changing in this formula is the rate that you're using to discount the future cash flow streams. And when you graph bond price against rate, we can now see the impact of rate changes on the price of the Walt Disney bonds. Okay, now, right now, this probably doesn't mean much to you. It just looks like a really nice exponential curve. But what's awesome about bonds, okay, is that from this, okay, if you were to go and take, I'm pretty sure Loyola still offers the a derivatives course, all right? And in the derivatives course that you could take, and I believe a guy by the name of, I think Douglas Young, I think he teaches the course. But you'll start to get into what other pieces of information can we extract from the shape of this curve. All right, we can obviously we see that it's exponential, right? And it's probably and it's a fifth order exponential curve, right? With an R squared of damn near 1 when you go out to the fifth order. So what we can do is if we were to take the first derivative, okay, of this curve, we'd have a line that was somewhere probably, you know, down in that would run right tangent to probably that spot right there. Okay, and when we take the first derivative, okay, of this curve, it gives us a really important metric called duration, right? And duration is a measure of a bond price's sensitivity to interest rate changes. Okay, so let's just say this bond has a duration of 4, right? It means that based upon the shape of this curve, okay, for every 1 percentage point change in the yield to market interest rates, that the value of this bond is going to change by 4%. Okay, so when I'm talking with my clients, all right, and they've got a portion of their investments in fixed income, it's very important for them to understand what their duration is of the bonds that they have, because that gives us an idea of how risky, how sensitive those bonds are to interest rate changes. Okay. And then you can take it one step further. So the first derivative is just a straight line, right? Just a straight line. But what we can do after that, there's another risk metric, and it's called convexity, right? So duration and convexity. And when we look at convexity, it can actually help us understand the speed at which the price will change based upon smaller movements in interest rates. Okay, so between duration and convexity, we get a very clear picture of how sensitive, okay, this Sleeping Beauty bond actually is to changes in interest rates. Okay, so what we glean here, okay, so we're at about a 7.55, so you know, right in there is kind of right there is the par value because we're at $1,000 bond price, right? So 7.55% that the bond was issued at is kind of right there. So we can see that if market rates drop to 5, okay, and we move from here to here, all right, there's a $500 price change in that bond, a 50% price change in the value of this Sleeping Beauty if interest rates drop from 7.55% to 5%. Okay. Conversely, if interest rates go to 10%, okay, all right, we see the price of the bond there at 755.01. Okay, so it changes to the negative by only $245. Okay, so we can see that as rates move lower, this bond gets very sensitive, okay, to rate changes, and it's less sensitive to the higher yield. Okay, so there's some added knowledge for you that you weren't expecting tonight. Any questions about that? Okay, bonds, you either love them or hate them, all right? But in terms of what you'll be tested on, all right, this is it, All right, this is going to be it. You're going to need to calculate bond prices at different initial coupon rates, at different changes to yield to market. You'll need to calculate yield to market based upon the other parameters of the bond. Okay, so that's what the Connect homework was all about. So if we're in Connect and we're trying to calculate yield to maturity, well, guess what? There's an Excel function for that. But again, if you were taking a different class with me and we were dealing specifically with bond valuations, all right, there are two formulas within Excel. There's an equals rate formula and there's an equals yield formula. So for the purposes of this course, the equals rate is the one that you would use. So equals rate, okay? And now it just asks for the variables, okay? The number of periods, the payment, the present value, the future value, okay? And that's it. You plug that in and it will return to you the yield to maturity, the yield to market, okay? So equals rate. If you're asked a question about what is the yield to market, okay, that's your trigger, your cue, okay, to use the equals rate function within Excel. Okay, and again, if you were taking the other course with me, it's equals yield. Okay, but in this one, you can see you've got to be able to put in a settlement date, a maturity date, what the rate is, okay, any redemption fees, how frequently are things being compounded. So it's just a different formula that gets you to the same answer. Okay. So equals rate is what you're going to want to be looking at. Okay. Any questions? Does that pretty much answer the questions that relate to bonds? Anything you want me to review as it relates to bonds? Okay, fantastic. I will put this out on Moodle later this evening. Okay, all right, and close this down. Before I close this down, any questions as it relates to, okay, so let's pause for a moment and let's think about like the basic concepts of what we're doing here, okay? We are trying to determine what the value of this asset is, right? The bond is an asset. We are trying to determine at the 50,000 foot level what the price of this asset is. How much would we be willing to pay for this bond right now? Okay. And we do that by looking at the cash flow streams that we expect to receive as part of our ownership of this asset. Okay. So what price would we be willing to pay, okay, for this asset, given the streams of cash flow, all right, that exist within the asset, all right? And when we think about it like that, the price we'd be willing to pay is the present value of all of those cash flow streams, right? That's how much we'd be willing to pay today at a certain given yield to market or coupon rate. So the price we're willing to pay for the asset today is equal to the present value of all the cash flow streams. And we saw that the longer we stretched out, okay, the longer we stretched out time before we got that $1,000 back, the less and less of an impact, okay, that future return of par value had on the actual price of the asset, right? And the bulk of the value of the asset was wrapped up in the present value of the other cash flow stream, the coupon payments. Okay. So based upon your watching the lecture on stock valuation, if we're talking about the coupon payments that we get from a bond, and we would transition to equities, what variable, what should we change the word coupons to if we're thinking about stocks?
Dividends.
Dividends, okay? So I could change this to stock price. I could change this to the present value of dividends, okay? And I could change this to the present value, okay, of that future capital gains that we might be looking at when we eventually sell it, okay? And you can see that the longer that we push out the sale of that security, okay, the less and less of an impact that the capital gains yield, the profit, okay, if you will, or loss if you're taking a loss, the less of an impact, okay, that return for owning, okay, the security itself, the less of an impact that actually has on the price of the stock. Okay, so the dividend growth model, okay, assumes, all right, that we push out the sale of the stock into infinity and beyond, okay, to Buzz Lightyear, all right? And there's zero value ascribed to that. And therefore, the value, the price that we'd be willing to pay for this stock today is nothing more than the present value of the dividends that we expect to receive, okay? And that's kind of what we see within this bond example, okay? So again, you cannot escape the present value, future value formula. It's in everything that we've done up until this point. It was in everything that you did within the midterm with the project valuations. It's now in everything that we've done as it relates to calculating the bond price. And as we see in about 5 minutes here, because I'm going to review the stock valuation, right? We're going to see that it has a very clear relationship. It's there. It's what it's all about. Okay. All right. Any other questions about this before I close it out? All right. Okay. From having gone through the stock valuation from last week, what questions do you have about that? Or do I need to kind of go through something similar to what I just did with bonds? What would you like me to do? Because quite frankly, we've got enough cushion built in kind of to the rest of the semester that I'm more than happy to kind of go through the stock valuation with you and then push off the conversation around capital markets until next week. But after capital markets, I got to get into CAPM, okay? And I want to get into derivatives and futures markets, okay? Because it's very important that we get into a conversation around options and futures and other derivatives before we finish out the semester. Okay, so I've got a request to go through the stock valuation. Okay, can I go through what we just did for bonds for stocks? Yes, of course. All right, that seems to be the prevailing request. So let's just do that. We will push off capital lessons from capital markets until next week, where we'll get into volatility, standard deviation, variance, and the impact that standard deviation has on expected returns for the investments you might be looking at. Okay, so I will just kind of run through this. Let's just get it going. So is it okay with you guys if I don't get into like the characteristics of the common stock and stuff like that and just kind of jump right into actual stock valuation? All right. The only thing that if you are tested on anything, the only thing that you need to know is that common stock has voting rights and preferred stock doesn't have voting rights. Okay, so read the first couple of slides. You're not going to be tested on anything other than, you know, those two key differentiating factors between common stock and preferred stock. Okay. Do we need to, does anybody want me to go through this? Okay, or did you kind of get a good idea of how to read a stock quote based upon the recorded lecture? All right, I'm going to skip past it. If you do have questions, hit the chat room and I'll come back to it. But I want to make sure we get into stock valuation. Okay, so we talked bonds. Okay, we talked the cash flow streams that are associated with bonds. And just like bonds, there are cash flows for stockholders. Right? If you buy a share of stock, you receive money in two different ways. You either get money in the form of dividends at some frequency, and you get money when you sell the shares of the company. Okay. And when you sell those shares, that can either generate a positive gain for you or a loss for you. Okay, capital gain or a capital loss. So just like it is with bonds, all right, the price of the stock is the present value of these two expected cash flows. Okay, so if we look at this example, right, we're looking at purchasing some stock in this company called More Oil. We're expecting to receive $2 of dividend in 1 year. And we expect, okay, based on Wall Street analyst forecasts, we expect to be able to sell this share of More Oil for 14 bucks. Okay. If we require, personally, we're measuring our own risk. And we've always said, if we're going to take risk, we need to be appropriately compensated for the level of risk that we're taking. And so when we do that, and we will get into how we go about calculating this expected return when we get into the capital asset pricing model. Okay? But our desire, our goal, we want a 20% okay, return, okay, based upon this level of risk with More Oil. So what is the maximum amount that I'd be willing to pay, you'd be willing to pay for this stock? Present value of cash flow streams, right? Present value of cash flow streams, okay? So we have to compute the present value of each one of those cash flow streams, okay? So for the present value, all right, what's the future value of, all right, the future cash flow streams? Well, we're going to get $2 in a year from the dividend, and we're going to get $14 from the sale of the stock. So we've got a total of $16. Okay, so the future value of this transaction is 16 bucks. Okay, divided by 1 plus our required return raised to the time period. Well, it's 1 year, so T is 1. Therefore, 16 divided by 1.2 is 13.33. So the present value of that future 16 bucks that we expect to receive is $13.33. So the price that you'd be willing to pay for this investment today with your required return of 20% is $13.33. Okay, that's what the price of the stock of More Oil Inc. Okay, that's what it's worth today if the required return is 20%. Okay, see the relationship now starting to build between stocks and bonds, but we're continuing to use variations of the same formula that you guys have been used to seeing. This is the same formula, right, that you used on the midterm to calculate the present value. Sorry, I got a bug in here. To calculate the present value of each one of those 10 years of future cash flow streams from the projects that you've developed the pro forma for. Okay. Now we're just applying it to stocks, bonds, and bringing in some different lingo. Right. So now what happens if you decided to hold it for 2 years? Okay. So what are the cash flow streams now for this investment? Well, at the end of year 1, okay, we've still got the $2 in dividends, still have the 20% required rate of return. So the present value of the year 1 cash flow, that's what this is 2 divided by 1.2. Okay. Now we get some information. Okay. So in addition to the dividend that you get in the first year, okay, you're expecting that More Oil is going to grow their dividend such that in year 2, you're going to get $2.10 in year 2 instead of $2. And the stock price is projected to be $14.70 at the end of year 2. So how much would you now be willing to pay for this investment for a 2-year holding period? Start to see the pieces, how they're coming together. This is the exact same stuff that you guys did when you calculated the net present value, when you did the pro forma analysis, when you were looking at the net present value analysis for the 2 projects. All right. Year 1, $2 of dividend, $2 of cash flow divided by 1.2 raised to the 1. Okay. Plus year 2's cash flow streams brought back into today's dollars. So the future value in year 2 that you expect to receive is the year 2 dividend, okay, plus what you expect to sell it for. That's the future, that's the FV, right? FV divided by 1 plus the rate to the time period. So 1.2 to the second power because we're in the second period. And when we sum each one of those present values for year 1 and year 2, we add those together. It's $13.33 is what that stock is worth. Okay. Now, it's interesting that it's the same value, right? It's really strange that it's the exact same number. Think about why that might be. And if you can figure it out before I tell you in the next couple of slides, bonus points to you. Okay, but if we look at a 2-period example, it's the same as the 1-period example. You'd still be willing to pay the same amount, $13.33. Why is that? Okay, and then let's just move into step 3, 3 periods. So instead of 1 year and then instead of 2 years, we're going to hold it for 3 years, right? Dividends are growing again in that 3rd year. Stock price is growing again at the end of that 3rd year. What are you willing to pay? Present value of year 1 cash flows, present value of year 2 cash flows, present value of year 3 cash flows, still $13.33. Still $13.33. Okay. So what is this telling us? It's telling us that just like we talked about with bonds, if we decided that we wanted to push out the eventual sale, okay, of the stock that we own, continue pushing that out, because that's all we're doing here, right? We're just moving the time period within which we're actually selling, okay, selling the holding, right? We pushed it from year 1 to year 2. Now we're in year 3. The dividends are growing. Okay, the dividends are growing by, you know, how much is that? 10 cents on $2. So that's 5% a year of dividend growth. Okay, and they're growing consistently at 5% each year. Okay, so we can continue to push out that sale. Okay, that future cash flow stream that we get from the sale of stock. We push that out all the way to infinity. And if we do that, just like we saw with bonds, when we pushed out the return of that par value of $1,000 out to 100 years, it wasn't worth shit in the overall price of the bond itself. Same thing here. If we do that and we make that assumption, we find that the value of the stock, the price of the stock, is really nothing more than the present value of all the expected future dividends. So now the question becomes, how do we estimate all of those future dividends? Okay, and we typically look at 3 different models when we're doing that. We have a constant dividend, also known as zero growth, right? So if the firm pays $2 a year in dividends per share, they'll pay $2 a year in dividends per share ad infinitum as a perpetuity. Okay, so this is kind of like a bond. Okay, and the bond equivalent of stock, okay, is preferred stock. So preferred stock, because it pays a constant dividend, Think of the Sleeping Beauty at 7.55%. Okay, it continues to pay 7.55% for 100 years. Okay, the equities counterpart to that is a preferred stock. You buy preferred stock of Disney, and that preferred stock is at 7.55%. You get 7.55%, no matter what. Okay, it trades like a bond. Constant dividend growth model. All right, CDG, where you forecast that each year the dividend will grow by a constant percent. Okay, so in the case of More Oil, it was growing by 5% a year. Each year the dividend would grow 5% more than the year prior. And then from here, the price is computed using what we call the growing perpetuity model, because we're using a growth rate that's going to continue for eternity. So it's a perpetual constant growth model. And then the third model that we've got, which we'll briefly talk about, okay, but you're not going to be tested on, is supernormal growth, right? Where you have some inconsistent dividend growth in the early years, okay, but then things start to kind of level off, okay, and then it eventually grows at a constant rate after that point. Okay, and none of this is hard. It's all just cash flows. You can calculate the cash flows for every one of these individual years in a supernormal growth modeling situation, and then you can model the future value of all the dividends once the dividend settles down to a constant growth rate. It's very easy to do within Excel. You just have to simplify it, okay, and think about it in terms of annual cash flows. What kind of cash flows exist for each of the years that you're looking at? And then do the same thing you did on the midterm and calculate the present value for each one of those discrete periods. Okay? And we use what's called a multi-stage model for supernormal growth dividends. Right? But again, we'll talk a little bit about this, right? But I'm not going to test you on it. Right? So when we think of zero growth model, okay, the dividends are expected at regular intervals, very important, okay? They're expected at regular intervals. It's not lumpy, right? And they're expected at those intervals to eternity, okay, forever, okay? We call this a perpetuity, okay? And the present value of a perpetuity is the expected future dividends, okay, divided by the growth rate, your required rate of return. What return are you expecting? Okay, and we have to adjust it for the compounding periods. So we got a stock that's paying 50 cents of dividend every quarter. Okay, it's never going to change. Okay, so it's 50 cents a quarter. Your required rate of return is 10%. It compounds quarterly. What's the price that you'd be willing to pay today for this perpetuity? Well, 50 cents per quarter divided by 10% divided by 4, so adjusting for compounding. Because it's a perpetuity and the formula is the price you'd be willing to pay today is the dividend you receive divided by your required rate of return, you'd be willing to pay $20 right now. The stock is valued at 20 bucks. That would be the zero growth model valuation for a stock that pays 50 cents in dividends every quarter with an expected return, required return of 10%. Okay, zero growth. All right, just the dividends you get, the future value divided by the required rate of return. The dividend growth model. Okay, this is what you're going to be. So you'll have a couple questions dealing with zero growth. That's fine. But this is where the rubber meets the road. This is what you're going to spend most of your time doing on Connect, okay, and on within the final exam. Okay, so the dividend growth model, okay, looks at cash flow streams related to dividends, because we just said that we don't care what we're eventually going to sell it for, because we're just going to hold it for a long period of time, and the present value of that future sale is basically worthless to us. Okay, so the dividend growth model only looks at the present value of all those future dividend payments, just like we did with the bonds, okay, where we said the present value of the coupons. Now we're just changing the word coupons to dividends, and now we're looking at what's the present value of all those dividends. Okay. So if we start with the basic formula, right? So in this case, and think about the present value and future value formula, all right? What does D1 represent? What variable does D1 represent? The dividend that you're expected to get next year. What does that represent? Think about your discounted cash flow analysis, okay? What does D1 represent? Is that the present value or the future value in a year from now?
Future value.
Future value, right? That's exactly right, Morgan. So if we look at just the first part of this formula, right? We can just substitute a few things. P0 is equal to PV. D1 is substituted for FV. And now we've got PV equals FV divided by 1 plus R to the T. Okay. You already know how to do this. It's just learning to recognize that you're just using a different nomenclature. Okay. So the present value of that year one dividend is D1 divided by 1 plus R to the 1. Okay. The present value of the dividend that you're going to get in year 2 is the dividends that you get in year 2. The future value, the future cash flow in year 2 divided by 1 plus the rate to the second period, right? Okay, future value, discount factor, okay? Future value times discount factor gives you present value in the time period you're looking for. So present value in year 1, present value in year 2, present value in year 3, and so on and so forth all the way out the curve. Okay, so now how do we factor in, okay, the constant growth on the dividend? Right? All we got to do is rearrange a few things, right? If we know that the dividend that we just got is going to grow by 5%, therefore the dividend that we're going to get next year is 5% more than the dividend that we just got, okay? We can take D1, okay, and translate that into, relate it back to the dividend that was just paid, D0, okay? The one that was just paid, the one that we just got today, okay? Oops, sorry, right? So D1, the dividend that we're going to expect to get next year, okay, is the same thing as what we just got times 1 plus the growth rate. So D0 times 1 plus G, okay, all of that is D1. Crystal, follow? Right? And we still have divided by 1 plus R to the 1. So we still, this is the exact same thing as this, okay? And D1 is equal to D0 times 1 plus the growth rate. Taking it one step further, and this is just math, this is just math, right? If we take in the second period, okay, D0, we got to grow it 2 times, right? So D0 times 1 plus G times 1 plus G, all right? Remember back to algebra, 1 plus G times 1 plus G is 1 plus G squared, right? So now we can convert D2 into something that relates back to the dividend that we just got paid. Okay, so D2 is equal to D0 times 1 plus the growth rate to the second power because it's in the second time period. Okay, and we do that on out the curve into infinity. Okay, so if you go back to your time series work that you would have done, I don't know, probably back in Algebra 2, okay, we can rearrange all this stuff. Okay, we can rearrange this formula into something that's much simpler to use. Okay, where now we're saying the price today is equal to the dividend that we just got times 1 plus the growth rate divided by our required rate of return minus the growth rate. And then with a little further math, we can now take D0 times 1 plus the growth rate, and we can convert that to D1. Okay, we just talked about that. So words matter. All right? If you get a problem that says company XYZ just paid a dividend, okay? The words just paid should trigger your brain to think, I know now that I've got to adjust it for the growth, okay? Because it was just paid, so I got to grow it. If you get a problem that says the company XYZ is expected to pay, okay? Those words expected to pay tell you that you're already talking about that future dividend. That doesn't require growth. So if you're going to make a mistake, okay, words matter. Okay, just paid versus expected to pay. Okay, so the dividend growth model says the price you'd be willing to pay today for the stock is equal to the dividend that you expect to receive in 1 year divided by your expected rate of return minus the growth rate of the dividend, all of which is derived from the time series work that you could do on the actual present value, discrete present value calculations. Okay. So you already know how to do this. You've been doing this all semester, calculating the present value for discrete periods of time. Now we're just applying it to how we go about valuing stocks using the dividend growth model. Okay. So if we look at Big D Inc., okay, keywords just paid a dividend of 50 cents a share. It's expected to increase its dividend by 2% a year. The market requires a return of 15% on assets with this level of risk. How much should Big D be selling for right now? Well, just paid, right, triggers us to know that we've got to grow it. Okay, so if they just paid 50 cents, we've got to grow the 50 cents by the growth rate that they tell us, 2%. So we got 50 cents. We're growing it by 2%. Okay, we're dividing it by the market required rate of return of 15% minus the dividend growth rate. And we do the math. The price that Big D should be selling for in the market is $3.92. Okay, so the dividend growth model allows us to calculate what the price of a stock should be valued at, okay, under constant dividend growth constraints. Okay. So here we go. Again, words matter. Expected to pay $2 in 1 year. So it means we don't need to grow it. Okay, expected to pay, that is D1. Okay, 5% a year growth rate, 20% required rate of return. The price we'd be willing to pay today is the D1, not adding 1 plus G or multiplying by 1 plus G. Okay, D1 is 2 divided by 0.2 minus 0.05. 13.33 is what we'd be willing to pay. That's what it should be valued at today. Okay. So just like we did with bonds, okay, we can build sensitivity curves to changes in dividend growth rates. Okay, and this is just one example out of an infinite number, but you can see how sensitive this particular company is with a D1 of $2 and a required rate of return of 20. Okay, how it is sensitive to changes in that growth rate. Okay, and it makes a lot of sense when you think about it back to the exponential nature of the time value of money formula. Okay. All right, let me just kind of go through the slide deck here and see what else I want to talk about. Okay, let's talk about how we go about finding the required rate of return, okay? Because that's also something that we need to kind of go through. So, okay, so sometimes you'll be given information around the company, okay, what it's priced at, okay, what its future dividends look like, what its growth rates are, and you need to figure out what the required rate of return is, okay, for the particular stock that generates the current price. So all we're doing is just rearranging the formula, okay? So P0 equals D1 divided by R minus the growth rate, when we rearrange everything and we solve for rate, this is what we get. So if we're told that it just paid a dividend, then the rate is equal to the dividend that was just paid times 1 plus the growth rate divided by the current price plus the growth rate. Okay, they're just rearranging the formula, okay, to solve for rate. That's all it is. So if you don't want to memorize the formula for rate, just memorize this formula, understand how it works, and then do the math to solve for R. Okay. Which then we can simplify the numerator, D0 times 1 plus the growth rate, to get to D1. Okay, so just paid, expected to pay. Okay, so again, words matter. All right. So obviously you can go through and you can do this math yourself. Okay, but firm stock is selling for $10.50, just paid a dividend of $1, so we got to grow it. Dividends are growing at 5%. What's the required return? Well, okay, we've got D0 times 1 plus the growth rate divided by P0 plus the dividend growth rate. We get to 15%. Okay, that's our total required return for this position. Right? What is the dividend yield? Okay, because remember, total return is comprised of two things: dividend yield plus capital gains yield. Total return is comprised of dividend yield plus capital gains yield. Okay, so the dividend yield is the dollars of dividends that we receive divided by the price of the holding. So the value of the dividends that we receive is $1.05. So D0 times 1.05. Okay, $1.05 divided by $10.50 a share tells us that our yield, okay, the return that we receive as a result of dividends alone is 10%. Okay, and if we know that total return is equal to dividend yield plus capital gains yield, then we can see, all right, that the capital gains yield is 5%. And it's no surprise that G is 5% because it tells us it's expected to grow at 5%. So now we just broke it down into two different components between div yield and cap gains yield. Right? Do we need, well, let's go through PE ratios. All right, real quick, because this is not overly complicated, and we've talked about PE ratios when we were into the first half of the semester and how we come up with the calculated stock price based upon earnings per share. Okay, so a lot of times we try to figure out, well, what's the value of a stock using the PE benchmark method. Okay, so for a company like Apple, all right, just as an example, Apple participates in the technology sector. Okay, and across the technology sector, okay, all the companies that would be included as within the technology bubble, okay, the technology sector benchmark price to earnings ratio, I don't know, let's just call it 10 for ease. Okay, so the benchmark of the technology sector is a 10, right? That means that when you take the sector prices that exist within the technology world, okay, so then basically just call it like an average of the stock prices, okay, is say a $100 average stock price, okay, and you look at the earnings per share of the companies that are involved in this technology bubble. So net income divided by number of shares outstanding is EPS, or earnings per share. So when we take that average benchmark stock price of 100 and we divide it by the average benchmark EPS of 10, okay, price over earnings, 100 over 10, tells us that the benchmark PE ratio for the technology sector is a 10. Okay, so what price should Apple be trading at, okay, based upon a benchmark of a 10 PE if Apple itself has earnings per share of 15? So they have EPS that's above the sector average. Okay. The price that Apple should be trading at is the benchmark PE of 10 times Apple's earnings per share. Okay. So if Apple's earnings per share are 15 and the benchmark is 10, then relative to the benchmark, Apple should be trading at a stock price of 150. Okay. 10 times 15. All right. So if you think about flipping this around, you've got benchmark PE ratio is equal to price divided by the earnings per share, okay, of the benchmarks. Right. So that is it's also a valuation method, and it's what we call the multiples valuation, right, where we're using a PE multiple to figure out what the potential value of a stock is. Okay, so again, these are data points, right, that give us an idea of what we'd be willing to pay for a stock, given either in relation to a benchmark to see whether or not that position might be undervalued versus overvalued, okay, or using the DGM constant growth model to figure out what the present value is for all those expected future dividend payments that we're going to get. That's the cash flow stream that we're looking at. Okay. And then, you know, you've got these slides that are in there to kind of go through, you know, what the various formulas are, just to kind of summarize, right? So that's stock valuation. All right, did that help? Yeah, okay. All right, any questions about stock valuation?
Yeah, I had a question. So in the Connect homework, there was a problem towards the end where you were given 3 different dividends that were paid or were expected to pay. And I was struggling with that one because I couldn't figure out exactly what the rate was. And I was like figuring that it was some sort of like average rate of return. Do you mind if we did an example that was similar to Connect?
Yeah, let me fire up Connect to see exactly, you know, which question we are referring to here. Okay, which question was it again?
It was one of the multiple choice questions towards the end.
Towards the end, okay. Let me just go down there. Okay. Three Corners Markets, Yummy Bakery, Geo, Crystal Glass. Crystal Glass recently paid $3.60 as an annual dividend. Future dividends are projected at $3.80, $4.10, and $4.25 over the next 3 years. Is that the one you're referring to?
I mean, we can do that one. I think like for me, like what I was struggling with is like, I knew that if I could find that growth rate, then I would be able to plug it in, and it was pretty self-explanatory from there. I just probably was overthinking finding the growth rate.
Yes, I think you were overthinking trying to find that growth rate, because this the mechanics, and if this is not the right problem that I'm referring to, please let me know, and I will try to find it. But I started at question 12, and this was the closest one to what you were describing. So this question is, the first thing that you had to do was you had to figure out, okay, what the price was projected to be, okay, in the third period. Okay, so you had to calculate kind of what the future sale price of this stock was for Crystal Glass in that third period. All right. So you had to figure out, because you're not holding it forever. Okay. So if you think about it in terms of the cash flow streams for year 1, year 2, year 3, we needed to find what's the present value of the cash flow in year 1. Well, in year 1, the only cash flow that you've got coming in the door are the dividends of $3.80, because it tells you that. Okay, it says recently paid $3.60, future dividends, expected dividends, right? Projected at, it gives you the three values. Okay, so you've got to calculate four different things. The first piece is, what's the present value of that future dividend that you're going to get at a 12.5% discount rate? You know, you've got the second year, the second period's dividends of $4.10. Okay, so you know you've got to do the discounting of that. Okay, and then in the third period, okay, you're going to hold it for that third period, but then you've got two cash flow streams that result from that. You've got the dividends that you're going to get in that third year, plus you're going to have the value from the sale of the stock. So you have to figure out what's the price in that third year that Crystal Glass is projected to be. Okay, so we know that if the perpetuity price, okay, is based upon that final dividend payment of $4.25, okay, then we know that P3, okay, P3, crap, let me just, I'm still sharing my screen. Let me go back here to open this up, and I'll show you a little more in more detail. P3, okay, has got to be the dividend, okay, that we're going to get, all right, the 380, all right, D1 divided by R minus G. So D1 or D3 in this case was 425, okay, times the growth rate, okay, so 425 was just paid times 1 plus the growth rate, divided by the rate of return minus the growth rate. You were given the discount rate of 12.5%, okay? And it was told that the growth rate was expected at 3.25% annually for the dividends. So when you do that, okay, the price that you're going to calculate for that third period, when you do that math, is, you know, in the numbers that I have, and the numbers are probably different for each one of you because Connect just throws different numbers out to everybody, all right? You get $47.44. Okay, so in addition to that $4.25 of dividend that you're getting in that third period, okay, you're also getting the $47.44. So when you now do the present value, the net present value for this example, you got the present value for the first period plus the present value for the second period plus the present value for the third period. And when you add all that up, you get the current price of the stock today of $42.92. Does that make sense?
Yeah, I think I just would like to see the math work, like
Okay.
with that.
I'll put something out there kind of on Excel, and just
Okay.
upload a little video just to kind of show you the piece by piece aggregation of the three different components. Okay.
All right.
But
Thank you.
Sure, yeah, 50,000 foot level though. Remember, all we're trying to do is calculate the present value of some future stream of cash flows. Okay, and once you grasp that, then just go very discreetly through the different periods using that present value formula. And then when you've done that, you can add everything up and you're good to go. Okay. All right. All right. It is 8:50. So would it be helpful if I added a few more questions out there that relate to bonds and stocks for valuation purposes? I can add a few more questions for Connect for practice. I can also probably this week put another video out there just kind of going through some of the questions that are out there on Connect, trying to explain kind of how the mechanics work to get to the answer that's needed, if that would be beneficial for you.
I mean, I would like more practice problems.
All right, I'm more than happy to
I
do
would
that.
too.
What's that?
Sorry, this is Morgan. I was just saying I would like more practice problems and Connect as well.
Okay, I can do it. I will get that put out there for you guys. And so next week, we'll kind of pick up with some lessons learned about the capital markets. And we're going to start getting into the capital asset pricing model next week, because I do want to get into a more detailed lecture on futures, options, and derivatives. All right. So if you do have questions, please reach out. I am happy to spend time with you offline, okay, if need be. So that's it. Any other questions for tonight? Okay, all right. Thanks for everybody's participation tonight. Great job on the Heritage Doll case. We'll get into the capital budgeting simulation for Heritage Doll next week. Okay, so we got a pretty busy night next Monday. I look forward to seeing everybody then. Stay safe, be well.
Thanks.
Thank you.
Thanks.
Thank
Thanks,
you,
sir.
everyone.
Night, y'all.